Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Palo Alto Networks.
If you find our talks useful, please consider subscribe, like, and comment underneath. Looking at the market right now, there's this massive, rapid wipeout in market cap over just a few months.
Yeah, it's pretty brutal. It's essentially what AI anxiety looks like in real time.
Exactly. I mean, we are tracking a severe 25% structural decline in the stock. It pulled back from highs of $209 in October of 2025.
Right, and it just cascaded down to a current level in the low 150 days. Specifically, I think it closed at $153.22 in late March 2026.
Which is a huge drop. So the real question we have to answer for you today isn't just, why the drop happened. We need to figure out if this indiscriminate selling has created a valuation reset.
Like a clean entry point for a premier asset.
Right. Or, alternatively, if the market is actually correct in pricing in the fundamental disruption of traditional cybersecurity.
Well, the broader market context right now is just entirely dominated by the specific technological anxiety. And you see aggressive selling across the entire software sector.
Oh, totally. Institutional investors are basically operating under the assumption that generative AI and autonomous software agents are going to just fundamentally break traditional software moats.
They are. But if you look past that sector-wide panic, the contrarian case building around Palo Alto Networks is actually really striking.
How so?
Well, the underlying data suggests they are actively monetizing this transition to artificial intelligence better and honestly faster than almost anyone else in the market.
Okay, so to figure out if this $153 level is actually a rare buying opportunity for you, we first have to isolate their underlying financial engine. We have to understand how they actually secure enterprise networks today.
Right, and the defining buzzword attached to their strategy right now is platformization.
Yeah, platformization. Think of traditional enterprise security, like a massive corporate office building. Management bought the padlocks from a local hardware store. They got the server room cameras from a big box retailer, and the lobby alarm system from some independent vendor.
And none of it natively communicates with anything else.
Exactly. So when a breach happens, security teams are just scrambling. They're trying to check 5 different siloed dashboards. Platformization is basically ripping all of that disjointed architecture out.
And installing one fully integrated self-updating master system.
Right. The network firewall natively talks to the cloud security, which then natively shares threat data with the employee identity scanner. It's all one nervous system.
And the financial implications of that architectural shift are massive.
Yeah.
When a Fortune 500 enterprise consolidates all of that into a single vendor's ecosystem, the switching costs become astronomical.
Because you can't just rip out your entire digital nervous system without suffering massive downtime.
Right, exactly. That vendor lock-in is the direct driver of the resilience we saw in their fiscal Q1 2026 results. Total revenue hit $2.47 billion.
Which is a 16% year-over-year increase, I believe.
It is. But the aggregate revenue growth is, well, it's solid. But the more critical metric for valuing this business is the actual composition of that revenue.
Because they're aggressively moving away from selling physical hardware, right?
Right. They are forcing a transition into high-margin cloud-delivered software. And the proof that this pivot is actually working is in their next-generation security annual recurring revenue.
Oh, those numbers were crazy. That specific metric surged 29% year-over-year.
Yeah, hitting $5.85 billion, sustaining a near 30% growth rate on a revenue base approaching $6 billion is, it's incredibly difficult.
It really validates the whole platformization thesis. It's not just a marketing concept anymore. Large-cap enterprises are actually signing these massive software contracts.
They are. And this is where the balance sheet becomes the ultimate differentiator. They're currently sitting on a staggering $16 billion backlog.
Wow. And just to clarify, that $16 billion represents contracted future revenue that just hasn't been recognized yet.
Correct. So in a volatile macro environment where IT budgets are getting slashed, that level of revenue visibility is a massive de-risking factor for investors.
Absolutely. But the metric that truly defines their operational leverage has to be the free cash flow. They've maintained free cash flow margins hovering near 40% consistently over the past 3 years.
And that cash generation profile changes their entire capital allocation strategy. Operating with a 40% free cash flow margin means they aren't reliant on capital markets to fund their growth.
Which is huge right now. In an era where the cost of capital has fundamentally shifted higher, being a self-sustaining cash machine lets a company be aggressively predatory.
Yeah, they can scoop up smaller competitors, fund massive internal R&D, and just weather macroeconomic storms without diluting shareholders.
Or taking on toxic debt. Which brings us directly to the core narrative tension driving the stock's recent volatility. They have this massive recurring revenue base, right?
Right. Incredible cash flow.
But the daily headlines are constantly warning that the artificial intelligence threat is going to dismantle these traditional security moats. And I have to push back hard on the bull thesis here for a second.
Okay, let's hear it.
If malicious actors are using large language models to write polymorphic malware at lightning speed, or, deploying automated bots that probe network vulnerabilities 204/7, doesn't that inherently commoditize traditional perimeter defense?
You mean because human speed defense mechanisms are obsolete?
Exactly. If the cyber attacks are instantaneous and automated, humans can't keep up.
And that specific vulnerability is the primary catalyst for the 25% pullback. The market is aggressively projecting that legacy security vendors will just be outmaneuvered by AI threats.
Right, which makes total sense on paper.
But the fundamental disconnect is that Palo Alto Networks isn't trying to fight artificial intelligence with legacy human speed tools. They are actually pivoting their entire platform to lead the AI security space.
Through the Cortex XIM platform, right.
Exactly. Instead of a human security analyst staring at a dashboard trying to manually correlate 10,000 separate login alerts, the XIM machine learning model contextualizes the entire data stream instantly.
So it identifies the anomaly, writes the mitigation script, and quarantines the compromised endpoint in milliseconds.
Right. It's literally machine versus machine warfare operating at the endpoint. The human is entirely removed from the immediate triage process.
And the enterprise adoption rate of this autonomous tool is just explosive. I mean, Cortex XIM recently posted 200% year-over-year growth.
Yeah, they now have 600 distinct enterprise customers spending over $1 million annually just on this specific AI module.
Let's talk about the retention metrics on that cohort too, because the net retention rate is sitting at 119%.
Which is massive.
It is. That implies the enterprise customers who integrated the XIM system last year found it so critical that they expanded their spend by 19% this year.
And software budgets are tight right now. Enterprises do not expand their spend by nearly 20% unless the product is solving an existential hair-on-fire problem.
And the underlying problem they're solving is severe analyst burnout. Security operations centers are just drowning in false positives.
Right, alert fatigue is a huge issue.
Yep.
By utilizing AI to automate the initial triage, they drastically reduce the operational overhead for their clients. But honestly, the even larger market opportunity is how they're addressing the next wave of tech adoption.
Now, this is the absolute most fascinating part of their near-term roadmap, the recent launch of Prisma AIRS 3.0.
Yes, they are targeting the highly specific, incredibly dangerous vulnerabilities of autonomous AI agents.
Because the entire tech sector is rushing to build agentic AI right now. And just to be clear, these aren't conversational chatbots that just answer questions.
No, these are autonomous non-human employees. Software agents granted the permissions to move data, execute financial transactions, parse private emails.
All without a human in the loop, which, from a cybersecurity and compliance perspective, is a nightmare scenario.
A total nightmare. If an autonomous agent roaming a corporate network gets hijacked, or if it just hallucinates and dumps proprietary source code into a public repository, the operational damage is instantaneous.
And catastrophic. But Palo Alto Networks is stepping directly into that governance void. They're creating the security infrastructure required to actually police these non-human workers.
They're effectively taking the biggest conceptual threat to enterprise software right now, rogue AI, and converting it into a net new, highly lucrative product category.
It's brilliant. They're becoming the mandatory prerequisite for a company to safely deploy autonomous AI agents.
Right, and by providing that governance layer, they transition from being viewed as an IT expense to being viewed as a fundamental enabler of business innovation.
Because if a Fortune 500 bank wants to deploy agents for loan processing, they legally cannot do it without the architecture provided by Prisma AIRS 3.0 to monitor them.
Exactly, so the underlying business fundamentals look incredibly strong. Robust free cash flow, clear AI monetization, massive backlog.
But we still have to address why the stock is currently trading at $153 instead of making new all-time highs. The bear case centers around two massive friction points.
Right, evaluation and the acquisition.
Yeah, first headwind is valuation. Even after a 25% haircut, The stock is trading at roughly 41 times fiscal year 2027 earnings estimates. The market is demanding absolute perfection to justify that.
But the much heavier anchor dragging the stock down right now is the staggering $25 billion acquisition of CyberArk.
And the market's anxiety regarding that specific transaction has fundamentally altered the company's risk profile, hasn't it?
It really has. Institutional investors are nervous.
I mean, I have to be deeply skeptical of this strategic move, too. A $25 billion acquisition is a massive pill to swallow, even for a company with 40% free cash flow margins.
I get the skepticism. The technological rationale makes sense, though. CyberArk specializes in privileged access management.
Right, securing the absolute highest level administrator credentials, the keys to the kingdom. But tech history is just littered with the value-destroying corpses of failed mega mergers.
That's fair. You introduce culture clashes, overlapping sales territories, fighting over commissions.
And the sheer engineering nightmare of rewriting competing legacy code bases so they actually integrate. If they get bogged down trying to digest CyberArk, it could crush their operating margins and cause this stock to tank significantly further.
The execution risk is definitely the most legitimate bear argument currently on the table. Integrating a multi-billion-dollar entity is never seamless.
So what's the counter-argument?
Well, you have to analyze their highly specific historical playbook. Their entire platformization strategy was not built purely on organic internal development. It was constructed through years of aggressive, successful M&A.
True, they do have a proven track record of identifying niche players and bolting them on without breaking the core architecture.
Exactly.
But the scale here is entirely unprecedented for them. Absorbing a publicly traded entity like CyberArk is a fundamentally different operational challenge than buying a $500 million startup. Just the headcount integration alone is a massive liability.
The scale is undeniably larger, but the financial shock absorbers they have are what mitigate the systemic risk. Look at their operating margins, which are currently sitting at a very robust 30.2%.
So they have a buffer.
A huge buffer. That inherent profitability provides immense breathing room to absorb the inevitable friction costs, the severance packages, and the restructuring charges.
Right. If their operating margins were sitting at like 5% or 10%, a $25 billion integration could theoretically break the company.
Precisely. And because of their cash machine status, they can self-fund a massive portion of this expansion rather than leveraging their balance sheet with dangerous debt.
Especially in a high interest rate environment. So when you weigh the spectacular growth of the XIM AI platform against the very real structural integration risks of the CyberArk deal, you have to look at how the smart money is positioning itself.
And the data shows a building wave of contrarian institutional interest. Retail and media are hyper-focused on the AI disruption narrative, but Wall Street is starting to dub Palo Alto the single best cybersecurity stock to accumulate right now.
Yeah, that shift in sentiment was really catalyzed by a rate research recently. They issued a significant upgrade to the stock.
Assigning a buy rating and establishing a price target of $185.
Which, if you're looking at the entry point around $153 in late March, that $185 target implies over 20% upside.
And the rationale behind the AREIT upgrade directly attacks the prevailing bear thesis. Their analysts concluded that the broader market is vastly overestimating the operational friction of the CyberArk integration,
while simultaneously underpricing how fast enterprises will be forced by regulators to adopt advanced AI security protocols.
Exactly. There's also significant rumor mill chatter backing this up. Industry insiders are suggesting that the Cortex Cloud platform is on track to become the definitive standard for agentic-first security.
And when a module like XIM grows at 200% year over year, it creates this undeniable gravitational pull, right?
Yeah.
It forces other vendors to build interoperability with Palo Alto rather than fight them.
Right. If they become the default regulatory standard for governing autonomous AI, you are looking at a multi-decade revenue pipeline that the market is just completely ignoring right now.
Because they're too stressed out about a quarterly integration timeline.
Yep. Establishing the industry standard would cement their moat for the next computing cycle. It shifts the narrative entirely away from integration risk.
Okay, so if the underlying business is sound and the analyst upside points to $185, what are the specific market triggers? Over the next 3 to 6 months, what's on the catalyst calendar?
Timing and entry here requires monitoring two major events. The first is the RSA conference, taking place in late April to early May of 2026.
The RSA conference is essentially a definitive proving ground for the whole industry, right? It's where major architectural shifts are announced.
Exactly. At RSA, the primary focus for you should be on product integration announcements. Management needs to demonstrate concrete progress on weaving CyberArk's capabilities directly into the Prisma and Cortex platforms.
And beyond the integration, I'd imagine we should watch for new enterprise customer wins or strategic AI partnerships.
Absolutely. This conference is their optimal venue to aggressively push the narrative that they are the apex predator in the AI security space,
And following RSA, the ultimate reality check will be the Q2 fiscal year 2026 earnings report.
which is expected in late May or early June. And for that specific report, top-line revenue beats are almost secondary. The institutional market will be zeroing in on two specific data points.
Let me guess the margin impact of CyberArk and the next-gen ARR.
Spot on. Management needs to prove that those 30.2% operating margins are holding firm. And they need to see if that impressive 29% software growth rate is actually sustainable at scale.
Because if they can demonstrate stable margins alongside near 30% software growth, the bear case basically
It
disintegrates.
totally falls apart. And there's a broader macroeconomic force at play here, too. We are watching a massive structural sector rotation.
Right, capital is aggressively rotating out of those speculative, wildly unprofitable AI experiments.
The market is sobering up. Capital allocators are hunting for established, highly profitable businesses that are actually extracting real, recurring revenue from the AI boom today.
And with 40% free cash flow margins and 200% growth in their AI modules, Palo Alto Networks is exactly the type of vehicle that rotating capital will seek out.
Synthesizing it all, the cash flow, the AI product market fit, the overblown integration fears, the underlying thesis is highly
Yeah,
robust.
that's the final verdict.
Evaluating the risk-to-reward ratio, Palo Alto Networks earns a bullish score of 7 out of 10. This is absolutely not a high-frequency trading setup, though.
No, the broader software volatility will definitely persist in the short term.
But for an investor operating with a 12 to 18-month time horizon, this 25% drawdown presents a deeply compelling asymmetry. It's a rare chance to accumulate shares in the structural consolidator of the security sector before the market wakes back up.
As the enterprise world races to build these autonomous AI agents programs designed to manage proprietary data and make high-stakes financial decisions completely without human oversight, you have to ask yourself a fundamental question. Over the next decade, will the most valuable tech companies in the world be the ones who are simply creating the artificial intelligence, or will it be the ones holding the keys required to secure it?